Hello everybody and welcome to Module 2 of our Financial and Managerial Accounting course. And this week we're going to be digging into the mechanics of bookkeeping and accounting, dealing with the transaction analysis, the journal entries, posting, and overall the accounting cycle. So before we can get much further, let's talk about what really the accounting cycle is. The idea here is that a company, as it goes through its lifetime, it has various months or years that it's trying to report on. So we'll break the life of the company into various periods of time, and then every time, and usually we're talking, months, but then quarters and years. Every time we go through that month or quarter or year, we complete what's known as the accounting cycle. So we're going to dig into the various steps of the accounting cycle. They really drive how we handle things. Now, I do want to mention one thing that's important. The different steps that we lay out sometimes are discussed slightly differently in different texts or courses. The step might be called something slightly different. It might use a different label. Or in some cases, they may split steps out a little bit more detail, or they may combine more steps into one. So we'll talk about an example, but the point is it's the same basic order. Even if you merge a few steps together into one, we're still going through things in the same order, and that's really what's more important. Nobody's going to ask you, hey, what is step 6 of the accounting cycle? Because that would really depend on how you learned it exactly. So they're more likely to say, this step, does it happen before or after another step? And again, it wouldn't be a number, it'd be the name or the description of that step. So before we go into the detail, let's give an overview on what we're referring to as the accounting cycle. And again, notice I have not labeled these as step 1 or 2 or 3, because as you'll see, some of them might be merged together, and I'll talk a little bit about that as we get there. But the very first thing we need to do is analyze the actual transaction that has occurred. You're basically looking at receipts, looking at documentation, trying to figure out what has happened and what accounts were impacted. Then number 2, you record those transactions in a journal entry, journalizing them. Then you pull apart those journal entries and post the pieces to the ledger. That'll all make more sense once we get into the detail. Once you post everything to the ledger, you get a running total of all those account balances, and you use that to create an unadjusted trial balance. Then after you get that, you go back and do some additional journal entries that are known as adjusting journal entries. Again, we'll get into detail later. You post those adjusting journal entries to the ledger. By the way, sometimes those two steps are merged into one, just adjusting. And then you complete what's known as the adjusting trial balance or the adjusted trial balance. It's the same as that first trial balance, only now it has adjusted entries. Then, using those adjusted numbers, you create the financial statements. Finally, after you're done with the financial statements, we close for the period, and basically this is resetting everything back to zero. Again, we spend time on this later, and we do the closing entries, we journalize them, we post the journal entries to the ledger, and then we have one additional trial balance called the post-closing trial balance. Same idea as the other trial balances, only now it gives us running total of only those accounts that still exist, that don't have zero balances, and will be carried over to the next year. So let's start on step 1 and dig into a little bit more detail. Here we are analyzing the transaction that has occurred to try to identify what has happened. Again, we take a look at the source documents. And source documents are just receipts, invoices, checks, anything that identifies what has happened and what the dollar amount was, who was impacted. Basically, we're identifying what transactions have taken place during the period, and we identify the impacted accounts, as I said. Maybe it impacted cash, maybe it impacted revenue, maybe it impacted a liability, and we need to identify whether we're increasing or decreasing that account. This goes back to Module 1 when we talked about the accounting equation, and we said it had to remain in balance. This was what we were doing in that case. Step 2, we journalize the entries. That's also known as recording. We're basically taking a look at the transaction, identifying what has happened, and we record a chronological record of transactions throughout the period. Now, again, as we talked about in the accounting equation side, every transaction has to have at least two accounts. So we said we can increase assets, we can increase liabilities. Our accounting equation had to remain in balance. Now, let's convert that, or let's translate that understanding to verbiage related to accounting, and now we start bringing in debits and credits. Now, we dig into these in much more detail shortly, but what I wanted to point out, first of all, is that you cannot say for any account in general, you can't say for all accounts that debits increase or debits decrease. Same with credits. It depends on the actual account, and that'll make more sense in a bit. But the point is, because we have to have at least two things going on, one of them has to be a debit and the other has to be a credit. There might be two debits and one credit, or two debits and four credits, as long as the dollar amounts match. The dollar amounts of the debits match the dollar amounts of the credits. This ties right back into the accounting equation, how we kept everything in balance. Step 3 would be posting to the ledger. Again, what we're doing here is we're taking that debit and credit journal entry that we just recorded, and we're pulling each individual piece and posting it to its corresponding account. So if the entry required a debit to cash, which by the way increases it, we'll talk about that later, and a credit to revenue, which increases that, then we take the debit to the cash and post it under the actual cash account to get us a new cash balance. We do the same thing with the credit to revenue. It would go into the revenue account. The point here is, after we post all the journal entries, we can take a look at each individual account itself and calculate a running total balance. Which brings us to the next step, where we would be preparing the unadjusted trial balance, which is essentially taking a look at every individual account in the general ledger, pulling the balance over to this report. So this report only shows the final balance of any individual account. It might have a debit balance or it might have a credit balance. It cannot have both at the same time. So we'll see what we mean by that in just a bit. The total debits from all those accounts that end up on the debit side must equal the total credits from all of those that end up on the credit side. Step 5, we are preparing and posting adjusting journal entries. Now this, again, when we see it later on, right now we're just running through the steps with a second level of detail. But the adjusting journal entries are needed for the accrual basis of accounting. A lot of journal entries, or a lot of original journal entries, are recorded essentially on the cash basis because we've paid the cash, we've received the cash, we need to record something at that time. The whole point of the adjusting journal entries is to take that cash basis and convert it to the accrual basis of accounting. Revenues are only recorded when they're earned, expenses are only recorded when they're incurred. So some examples of adjusting journal entries would be, for example, what prepaid assets have been used up during the period, like supplies, insurance, things like that, and we convert it to an expense. What unearned revenue has actually been earned, we convert that piece to a revenue. What expenses or liabilities have been accrued throughout the period, we have to force that recording of it. And what revenues and assets have been accrued throughout the period. All of these will make more sense when we get to the detailed examples. Step 6, we're going to prepare the adjusted trial balance. Now that we've done some more journal entries, some more recording, we'll bring the new balances of each individual account over to this report. It's just a trial balance. The main reason for this trial balance is to give us the numbers we need to create the financial statements. Which takes us to the next step. We're preparing those financial statements. Income statement, retained earnings statement, also the statement of changes in owner's equity kind of combined. The balance sheet, and then the cash flow statement. They are required in that order. And again, because we just prepared the adjusted trial balance, most of those amounts are what you find on the financial statement. Of course, you have subtotals and things like that, but the individual line item amounts come from the adjusted trial balance. Now, the whole point of the adjusting entries and all of that was to prepare the financial statements at the end of the period. Now we need to start next period fresh. So there are certain accounts that need to be closed out. Things like revenues, expenses, and dividends. We only want to know one period's value for that account, and then we start the next year zero. Those are all closed to retained earnings at the end of the period through these closing entries that, again, we'll see the detail later on. And the point of retained earnings is it's a permanent account. It carries over the ending balance from year to year. What I want to mention here is that when we get into these closing entries later, we're going to find out that what we're doing essentially mimics what's going on in the retained earnings statement, where, we started with beginning retained earnings, we added in net income, which is revenues minus expenses, and we subtracted dividends, and we got an ending retained earnings balance. So we'll see the closing process mimics this statement. The other accounts, we talked about the income statement accounts, revenues and expenses, and then we threw in dividends. Those are what are known as temporary or nominal accounts because they get closed every period. The remaining accounts always keep a balance. They're called permanent or real accounts. And for the most part, there are core balance sheet accounts, assets, liabilities, and our two main components of equity, the paid-in capital and retained earnings. Now that we have prepared the post-closing entries and posted them, so here we merged two steps together, journalize and post closing entries, then we're going to prepare the post-closing trial balance. It's our third trial balance, and the difference with this one is that there are many accounts that will no longer exist. Your revenues, expenses, and dividends should not be on here because they have a zero balance. This should only contain all the assets, all the liabilities, paid-in capital, and retained earnings. Now, just like all trial balances, we want to make sure that our debits and credits still keep a balance. Now, step 10, what I've listed as step 10, is a completely optional step. It's reversing entries, preparing and posting reversing entries. It's not something that all that many companies do, and if they do, it's usually behind the scenes in their system. The point is that the only reason we did adjusting entries was to convert to the accrual basis of accounting for the financial statements. That's the only requirement. Some companies like to know the kind of quote-unquote real transaction data, which they refer to as the cash basis. So what they do is they reverse the adjusting entries back to what has truly taken place from a cash perspective, and then they operate that way until the next period's financial statements, and then they would, of course, have to adjust again. We're not going to see this one in more detail, but we will certainly talk about examples of adjusting entries. So the whole point of that discussion for the first little bit of this module was to walk you through a very high-level view of the accounting cycle and then go through a little bit more detail of each individual step. But now we're going to start going to the great detail and seeing examples. So before we can go any further, we have to talk about a concept known as normal balance of an account. But then before we can even do that, we need to know what balance means in general. So what I have here are two general accounts. We don't even know the account name or type. Now, debits, as a rule, first of all, I guess I should mention this. What you see right here is called a T account. You can see it looks like a T, and it has two sides to it. The left side, which is always going to be a debit, and the right side, which is always going to be a credit. You cannot tell, because we don't know what account this is, we cannot tell whether this debit is increasing this account or decreasing it, or whether the credit is increasing or decreasing. The only thing we can tell is what the balance is, the dollar balance, and which side it happens to fall on. Generating the balance of any account is simply adding up all of your debits and then separately adding up all of your credits and taking the difference between those two. Here there are 400 debits, 350 credits. There are 50 more debits. That's all we can tell about this account. So this account has a debit balance of $50. It's as simple as that. We don't know if this is positive. We don't know if it's negative. We just know it's debit. Here on this other account, we have 300 credits, and it looks like 150 debits. So we have 150 more on the credit side, so this balance becomes a credit balance of $150. Again, we have no clue whether that's a good thing or a bad thing because we don't know what account type this is. This is balancing an account. This is the T account. And remember the big rule that debit is always on the left, credit is always on the right. Doesn't matter what account it is. Doesn't matter later on when we find out debits might increase or might decrease a particular account. None of that matters. What matters is debit is always left, credit is always right. Now that we've identified that, let's talk about normal balance. Now, even though in the T account, I do want to clarify this, in the T account, in the journal entries, you'll never see a negative sign. Everything is always entered as a positive amount, and it's either debit or credit. But what we need to find out is for that account balance, again, is that where it's supposed to be? Is that a positive amount for that account balance, or is that not a good thing? It might be a negative balance. And we talk about that in debit and credit terms. So before we can do that, we need to know what the normal balance of an account is. In other words, what side would we want it to be on to be considered positive? And that also tells us, that same thing tells us what do we need to do to increase that account. The normal balance, again, debit or credit, whichever one it happens to be, is what you do to increase an account. You do the opposite to decrease it. Debits and credits are opposites. Now, most accounts, just by their nature, can only end up on their normal side, and they very seldom, if ever, would fall on the opposite side when all is said and done, the abnormal side. But if they did fall on that abnormal side, even though you won't see a negative sign anywhere, that essentially means it has a negative balance. I'll explain one example later on. Remember, we have to go back to our basic accounting equation. Assets equals liabilities plus equity. We talked about that before. They have to stay in balance. And we explained that as by saying the assets or the resources must be equal to whoever has claims to those resources, either the creditors or the owners through equity. The other way of looking at that was that the resources we have must equal the financing we had for those resources. Somehow we got the financing to buy whatever, $1 million of assets. Where did that $1 million come from? Borrowing through liabilities or owner investment through equity? Now the next step is to refresh a slide we talked about in Module 1 where we expanded that accounting equation. We said we have assets, liabilities, but then we broke owner's equity into two components: contributed capital, sometimes called paid-in capital, and retained earnings, sometimes called earned capital. Now, retained earnings can further be broken down into, of course, the beginning retained earnings balance impacts it, but we also have net income, which is further broken down into revenues minus expenses, and then dividends impact retained earnings as well. So the 6 account classifications I've bolded in red are what we really need to know to understand normal balances. These are the 6 account classifications, and we're going to identify what normal balance they have. So remember that assets are on one side and liabilities and equity are on the other. So the normal balance rule for assets is that a debit increases the assets. In other words, the assets have a normal debit balance. Credits decrease them. It's the opposite. So assets have a normal debit balance, which tells us that liabilities and equity have to be the opposite in order to balance. So liabilities and equity overall have normal credit balances. They're increased by credits and they're decreased by debits. But I want to stress here that I'm talking about equity overall as a top level category. When we break equity into its basically four things that impact it, we have the capital, paid in capital, contributed capital, whatever term you want to use. That has a positive impact on equity. So if we increase capital, yes, we increase equity. So it's going to have the same normal balance rule as equity. A credit to capital is like a credit to equity. Revenues, exact same way. When we credit revenues, we're increasing the revenue, which increases net income, which increases retained earnings, which increases equity. But the tricky part here is expenses and dividends, because those have a negative impact on equity. If you increase an expense or if you increase a dividend, that ultimately decreases equity. For that reason, it has to have the opposite normal balance rule of equity overall. It has a debit balance, much like assets, but more importantly, it's the opposite of equity. It's the opposite of capital and revenue. Expenses and dividends have a normal debit balance. They're increased by a debit, which in turn decreases equity. So I've got another way of teaching that and having you memorize it in just a bit. But the very first thing I want to mention here, it's something that tripped me up in my very first week of accounting for a bit. Dividends are not expenses. Even though they both have debit balances, they're not expenses. In fact, dividends don't even impact net income at all. Expenses do. Dividends go straight to retained earnings. Expenses go through net income and then to retained earnings. So the biggest thing to remember is dividends. There is no account called dividend expense. Let me put it that way. Dividends are a separate type of account all amongst themselves. Now let's talk about another way to learn the normal balance rules. This is the way I was taught way back in my first week of accounting, and it's stuck with me all these years. DEAD is actually the mnemonic I was taught, D-E-A-D. Now that tells us that the debit accounts include expenses, assets, and basically dividends, sometimes called drawing. So you have your your 3 debit accounts out of your 6 total accounts. The remaining 3 accounts fall under the clerk mnemonic. It's not a perfect word, it's missing some letters, but we have credit accounts include liabilities, revenues, and capital or common stock. So here we're saying that the normal balance of these accounts, here these ones are debit, these ones are credit. That tells you what to do to increase that account. Now let's look at that in action. Cash is an asset which has a normal debit balance, therefore it's increased by debits and decreased by credits. Now I'll explain cash in just a bit. It might be jumping out as you might see some alarms running right now. I'll mention that just a bit, why it truly has a debit balance. So every time we add more debits, we're adding more to the debit side, which is a positive side for cash. Every credit decreases the account. But remember, the balance of this account is simply the total debits minus the total credits. We have 150 extra debits. So that's our balance, debit $150, which for cash is good. Now we add another, we added another 2 separate hundreds to the account. That increased our balance by 200 from 150 to 350 because now we have even more on the debit side. Now we added 200 on the credit side, which decreases the balance. It decreases the difference between the two. Now here's the trick. We added another $200 on the credit side, which now pushes the credits above the debits. Our balance is now $50 on the credit side. For cash as an asset, that's abnormal. That should not happen. That means we essentially have a negative balance. Again, you're not going to see a negative sign anywhere here, but that essentially means, in fact, on the balance sheet, if we were doing that, it would be a negative balance. Now, cash, you think about that. How do you have negative cash? Theoretically or technically, the only way that could happen is if you overdrew your bank account, because that's part of your cash account. And, of course, that should not happen, and you need to correct it very quickly, but that's theoretically how it could happen. Cash is one of the very few accounts that even theoretically could have a negative balance temporarily. So let's talk about cash in more detail because it seems odd. Cash is an asset. I just said that assets have normal debit balances. Debits increase assets, credits decrease them. The other thing that tricked me up my first week of accounting was that I pulled out my checking account register and I saw my deposit and withdrawal column. Deposits were labeled as credits and withdrawals were labeled as debits, which seems to be the exact opposite of what we just learned. Here's an example of a pretty old checking account register. Payment, in other words, withdrawal, subtraction, is a debit. Deposit is a credit. So that seems the opposite of what we learned. But what you're looking at with this ledger right here is not a cash account. To you it is, but it's the bank that gave you that account. They set it up on your behalf. It's actually their liability account. That's the perspective we're looking from. The bank has a liability account. Liabilities have credit balances. When you deposit money, they immediately need to record the fact that they owe you that money back down the road sometime. So when you deposit, you're essentially crediting their liability to increase it. When you debit or when you withdraw, you're debiting that account to decrease their liability because now they don't owe you as much money. That's what's going on here. And once I understood that the first week, it made sense. But you cannot come from it. You cannot look at your checking account register from a cash account perspective. Look at it from the bank's liability perspective. Just remember, cash is definitely an asset. It definitely has a normal balance and is increased, a normal debit balance, and is increased by debits. So we need to know the debits and credits are very, very important. They're going to pervade throughout the rest of this course and accounting in general. They're the basic language of accounting. We need to understand that to be able to record journal entries, keep account balances, all of that. Now, we already talked about the whole checking account register, but the other thing I want to throw out is that the use of the term debit card and credit card can really cloud things up. So the best thing to do is just not try to look at it from that perspective. It's just learn from what we've talked about here. What you do need to know, again, is that debits and credits are opposites. If one particular account is increased by a debit, the opposite, the credit, decreases it. And we talked about the normal balance rules. What you need to remember, again, is that debits are always on the left side of an entry. Debits always come first. By the way, debit, DR is the abbreviation for that. It stands for debit record. Don't get debit confused with debt or debtor. Yes, they have similar Latin roots to them, but we're not talking about liabilities like we owe someone some money. Don't confuse it with that. Just think of debit in this abstract term that we're talking about. Credits are always on the right-hand side, and again, don't confuse credits with creditor, somebody you owe money to. CR is the abbreviation for credit, and that stands for credit record. So we're going to go through the first few steps of the accounting cycle in more detail now, and then we're going to pause and come back in part 2 of Module 2. So right now we're talking about recording the transactions in a journal entry. So what we have here is an example of a journal entry in its format. Now you'll notice that you have the date of the transaction, you have which accounts were impacted by the transaction, and then you have your amounts. Occasionally there's an explanation of that transaction underneath, but the important thing to note here is that your debits always come first and they're aligned on the left. Your credits are always indented to the right, just like left and right on the debit and credit of the T account, and then your amounts are accordingly aligned to the left for debits and then to the right for credits. This is a proper journal entry format. You do not reorganize them. Remember, you can have like 2 debits first and then a credit or whatever, but all the debits you have for that account have to come first, and then whatever credits you have for that transaction come next. Here's an example where we have 2 debits and 1 credit. That's fine, 2 and 1, as long as your total debit dollar amounts match your total credits, $250 and then $250. So we're good to go there. Now that's that journalizing step of the accounting cycle. Now let's talk about posting them to the ledger. So for any account transaction that we have, here we have 1 debit and 1 credit, we have to pull each piece out. A $500 debit to cash has to go over to the cash account, the T account or the ledger. The $500 credit for revenue has to be pulled over to the credit side of the revenue account. Here we have a debit to inventory for $200 that has to be pulled over the inventory T account. The $200 credit to cash has to be pulled over there. And notice that the balance, we're keeping a balance each time. Now we talked about the rule for balances, how to balance an account. We went through normal balances, and we said if the account ends up on its normal side, then it's positive. If it ends up on the opposite side, it's negative. Now let's go back to the balancing rules. We said that every individual journal entry has to have a balancing debit and credit dollar amount. However, for an individual T account, it does not have to have equal debits and credits, and in fact, if it does, it has a 0 balance. So let's go back to see what I mean here. This cash account here, it has a debit and it has a credit, but the balances certainly don't equal out, and that's perfectly fine within one account, because that means we have an actual balance. If it was $500 on both sides, that would mean our balance was 0. So within a T account, it doesn't have to balance out. In the journal entry, it does. And then furthermore, when we bring all of the accounts forward to the trial balance, which we'll see next, they have to balance out again. So now we're going to talk about the unadjusted trial balance, which again is simply a listing of every account we have that has a balance and what that balance is. Some of them have debits, our assets, our dividends, and our expenses. Some of them have credits, our liabilities, retained earnings, revenues, and capital. Now notice, no account has something on both sides. That's not proper. We want the actual total balance of that account, not just the sum of its debits versus the sum of its credits. What is the balance? What was the difference between the debits and credits for that one account? We bring it over here. We add up all of our debits. We get $108,550. Add up all of our credits. We get the same amount, and we're good to go. Now, the reason they call it a trial balance is you're testing. You want to see, first of all, if these balance out. And if they do, you're good. Well, if they do, then you don't have any very obvious errors. That doesn't guarantee that something's not wrong, but it guarantees that at least you follow the balancing rules. If these are out of balance right away, you know there's a mistake you've got to go correct. So that's the point I wanted to make here. And that wraps up part 1 of Module 2. As I said, I want to keep these around 30 minutes. So we'll come back and see part 2 here in the next video, and then we'll wrap up our mechanics of bookkeeping and accounting.